Now, certainly there's been quite a bit of action in recent weeks in terms of the economy, like Tassie coming out on top of the CommSec State of the State report for the 9th quarter in a row, and the news the Reserve Bank has increased the interest rate for the first time in over a decade. So certainly time to check in with our resident economist, Saul Eslake, who's been overseas in Switzerland while all of this was happening. Saul, good morning. Welcome home.
Thank you. It's good to be back in Tasmania, as always.
How was Switzerland?
Well, I was in London mainly for work, furthering a new partnership I'm developing with a London-based economist to give us a global reach. Was in Zurich for seeing some clients there, and in the middle of all of that, able to have some leisure and pleasure travel in southwestern Germany, and for the first time in my life, a little country called Liechtenstein that I had never been to before. So
what's it like?
That was well, it's a very small country of about 40,000 people, so it's, kind of Burnie and Devonport put together. It's wedged in between Switzerland and Austria, and the capital Vaduz is on the flat, almost on the banks of the Rhine River, which curls around the border between Switzerland and southern Germany, and then comes down from the Swiss Alps. But there are some very high mountains on either side of the Rhine River there. Some are in Switzerland, some are in Liechtenstein. And it's just a beautiful little country, and this was a very good time of the year to be visiting it, as spring is out, and the people in that part of Germany, Switzerland and Liechtenstein in particular, celebrate it being asparagus season. So almost every meal I had during the daytime, I'd have white asparagus in soup or with whatever it was that I was eating, and it was really very nice.
Oh, it sounds lovely. Just briefly, how was the COVID situation over there?
Well, it was interesting that there were very few restrictions at all, certainly no requirement for PCR or RAT tests when you arrived or left. There was very little mask wearing. Whatever mask wearing there was voluntary rather than compulsory. When I flew from Zurich to London, you weren't required to wear masks at the airport or on the plane, although ironically when I flew back from London to Germany with the same airline that I'd flown to London, you had to wear masks on the plane then, but you didn't have to wear it in the airports. I've got mixed feelings about this. I mean, COVID is still circulating widely within most European countries, and although as in Australia far fewer people are getting seriously sick from it because vaccination rates are not quite as high as in Australia, but nonetheless a lot higher than they are in the United States. And while wearing a mask, particularly flying back to Australia through Singapore, had to wear a mask for what was effectively about 26 hours. That's not fun.
No.
I don't regard it as an unreasonable precaution while COVID is still circulating. But I tell you what's a real relief is just to be able to cross from one country to another without having to quarantine, or indeed in European countries without even having to show a passport to anyone. And I was again reminded that when you leave the UK, like when you leave the United States, you don't have to line up to show your passport to anyone as you do when you leave Australia. You have to show your passport when you come in, of course, and that's perfectly reasonable. Countries are entitled to know who's coming in, but it does make me wonder why Australia makes people line up to show their passports in order to get out, when countries who are no less concerned about who comes across their borders than we are, such as the US and the UK, don't require that at all.
It is interesting, but let's just move on. I mean, at least you don't have to see an economist to claim it on tax. But listen, you've certainly a bit of action while you're away, I've got to tell you. We'll start with the CommSec report briefly. Of course, our government, and why not, bragging about the positives of the report. There's probably quite a few things stood out for you.
Well, I only saw a headline about this report while I was away and haven't looked at the detail of it. But as we've discussed before, this is good news. It's an affirmation that the Tasmanian economy has, for some time now, been performing considerably better than it had been over the previous 15 or 20 years. But it's also important to recognise that the way this particular report ranks the performance of each state is not by reference to how well they're doing relative to the others at any particular point in time, but rather how well they are doing by comparison with their average on each of 8 indicators over the previous 10 years. So a state which has been doing poorly but then improved significantly will rank much higher than a state which may be doing better in absolute terms than Tasmania, but has slowed down from a much faster rate earlier in the decade. And that's still the case. I mean, Tasmania's economy is doing well. I wouldn't want to take anything away from that. But the fact that we're on top of this indicator is more a measure of most improved than it is of best in class.
I see what you mean. Tell me about rate rises. You would have been interested in that, especially what we're expecting, what we see. I mean, the interest rates we know now, it doesn't matter what government gets in, it's going to be constantly going up till the end of the year, possibly up to 4%, maybe 6%.
Well, the mortgage rate, which for some lucky people had been about 3.67% at its record low, the standard variable mortgage rate got down to a bit over 4%. That will probably rise by about 1.75 to 2 percentage points over the next 18 months or so now, to a level that by historical standards would still be very low. The cash rate, that's the one that the Reserve Bank sets, which is in turn a benchmark for variable mortgage rates. The Reserve Bank raised that from 0.1% to 0.35%. If they raise that by 2 percentage points over the next 18 months, that would take it to 2.35%. That would still be 0.8 of a percentage point, 0.9 of a percentage point, lower than the so-called emergency level to which the cash rate was lowered during the global financial crisis of 2008-09. So although rates are going up, and that will be uncomfortable for people who took out big mortgages while rates were at record lows, it would still be a very low interest rate. And most people, other than those who took out really big mortgages over the last 2 years, most people, I think, will be able to cope with that. I mean, after all, while all the politicians are falling all over themselves to say that Australian families are struggling with cost of living pressures, and those at the bottom end of the income distribution, people on pensions and other social security benefits, people earning the minimum wage, or people working only a few hours part-time, they undoubtedly are finding it difficult with the prices of petrol and groceries and so forth having gone up a lot. But both the Treasury and the Reserve Bank are forecasting that household spending will rise by more than 5% in real terms, which is a big increase.
Yes.
Retail sales have risen by an average of 1.5% in each of the past 3 months. And households in aggregate have accumulated $275 billion in additional bank deposits since the beginning of COVID. Now, obviously, very little, if any, of that will have been accumulated by pensioners and people on the minimum wage. But I would say the majority of Australian households, even though they are paying higher prices for groceries and petrol, among other things, are coping pretty well, if the retail sales and other figures are any guide.
It's interesting, though, when you said historically, because I remember 1990 when it was, 17% that I was paying, absolutely ridiculous. But the cost of the house was so much lower. So it's kind of comparable when you consider the prices of houses now. And, I mean, that's the situation that's so much higher. And I am aware the banks are, they test for mortgage stress, don't they, when you're actually trying to go for it? And
well, they're supposed to. They're required by APRA, who are the regulators of banks, to ascertain whether a mortgage customer could absorb increases in interest rates of up to 3 percentage points in deciding how much to lend to them. Now, you can't be absolutely confident that the banks always abide by those criteria. Someone, I think it was Warren Buffett, used to say it's only when the tide goes out that you find out who's been swimming naked. And it may be...
That's a good... I like that.
As interest rates go up, it may be that we find that the banks have been lending more to people with limited capacity to absorb interest rate increases than they should have been doing. But at this stage, the judgment of the Reserve Bank and others is that apart from those who took out big mortgages with rates at record lows, most Australians with mortgages should be able to absorb increases of the sort that we're contemplating over the next 18 months. And that's not to say to be pleasant. It's not to say that some people with mortgages will have to make some trade-offs, might have to postpone holidays or in some other ways cut some discretionary or non-essential spending. But most Australian households will have the capacity to do that, whereas, of course, those who don't have homes and who are renting who are typically people on lower incomes than people who are buying homes or who own them outright, they're going to face continued increases in rent as well, as they have been doing in Tasmania for the last 3 or 4 years.
Now, Saul, the federal election, 5 sleeps away, thank heavens. Let's talk to some of the policies and commitments we've seen from the major parties, starting with the super home buyer scheme announced yesterday from the Liberals. This would allow first home buyers to invest up to 40% of their superannuation, up to a maximum of $50,000, to help with the purchase of their first home. And from what I've gathered, you're not in favour of this.
No, I think it's a contender for the title of worst housing policy in the last 25 years, along with the cut in the capital gains tax rate in 1999 and the Howard government's decision to extend first homeowner grants to people who bought established houses as well as new ones after the introduction of the GST, even though the GST didn't apply to purchases of established housing. And this super for housing policy is the latest in a long string of policies going back to 1964, when John Howard, who at the time had been president of the New South Wales Young Liberals, persuaded Sir Robert Menzies to offer the first homeowner grant at the 1963 election, which he then implemented the following year. I don't think it's a coincidence at all that Australia's home ownership rate peaked at the first census after that policy started in 1966 and has been going down ever since, because we now have almost 6 decades of, I think, incontrovertible and unequivocal evidence that tells us that anything that allows some Australians to pay more for housing than they otherwise would, whether it be first homeowner grants, stamp duty concessions, preferential tax breaks for property investors, shared equity schemes, mortgage guarantee schemes, or, as you just said a moment ago, lower interest rates. Anything that allows Australians to spend more on housing than they otherwise would results in more expensive housing rather than in more people owning that housing, that is, in higher home ownership rates. And that is what this scheme will do. It will allow a small number of people, probably, because there aren't a lot of people who have, for example, 100,000 in super, that they can take out 40 or 50,000 of it, and then remember that goes into the deposit, so that people will then be able to borrow 4 times as much if they can service a mortgage on it. So they will be able, as a single, perhaps to pay $200,000 more, as a couple, maybe $500,000 more for housing than they otherwise would. This is, as the minister responsible for part of this, Jane Hume, conceded on radio this morning, this will cause prices to rise. Matthias Cormann, who was finance minister in the Abbott and Turnbull governments and is now Secretary General of the OECD, which is one of the bastions of economic orthodoxy in the world today, he said in 2014 that allowing people to use their superannuation for housing would put upward pressure on house prices and make the problem worse.
Can I just ask you a question about choice? Because, I mean, and I don't think anyone's going to be arguing with you in regard to upward prices of homes, but you've also got, and you mentioned shared equity, you've got the Tasmanian, what they call it, the housing market entry program launched July 1. I mean, I think there's going to be a lot of confusion out there for those who wish to buy a home, young home buyers. They've got this, which is argumentative, realistically, as we hear with you. And also then you've got this choice with the Tasmanian government. I think people need to have all of this explained a lot more than it is. I mean, what about that 300,000 super concession for over 55s who sell their home to downsize?
Yeah. Well, again, what this and the super for housing policy announced by the Prime Minister yesterday demonstrates, for anyone who hadn't noticed beforehand, is that the coalition intensely dislikes the compulsory superannuation scheme. And I think the reason they intensely dislike it is because it gives unions a bigger role in the economy through their representation on the boards of employer-employee or industry super funds.
And it was Paul Keating's idea.
Well, it was Paul Keating's idea. I mean, so was floating the dollar, for example, and deregulating the banking system. But it gives unions a bigger role in the economy than their declining membership would otherwise warrant. I think that's part of the reason why they don't like super. The only thing the Coalition likes super for is allowing older Australians to pay less tax. And that's what the downsizing proposal is really about, is it's yet another way of allowing wealthy older Australians to put money into superannuation where it is taxed at a much lower rate than it would be if they kept it in their own hands. And the Coalition has been doing this since about 2001. And, this flies in the face of the fact that the proportion of household wealth owned by Australians over 65 has risen from about a quarter 18 years ago to over a third in 2019-20. And yet, despite the fact that older Australians are now richer than their younger counterparts, this government, the Coalition, whenever it's been in office, has come up with successive ways of allowing them to pay less tax. And, that should be frustrating to people who are younger and less wealthy, who are having to pay more tax because older, richer Australians are paying less, and who are also being frozen out of the housing market by policies that, irrespective of what politicians say when they're introducing them, have the effect of pushing up the price of housing. And, I often, over the last 40 years that I've been thinking about this, ask myself, why do politicians of all political persuasions, not just Coalition, but Labor ones, why do they keep doing things that serve to inflate the demand for housing and push prices up, whilst at the same time supposedly expressing concern for young home buyers who are increasingly locked out of the housing market? And I can't avoid the conclusion that the reason they do it is that despite the crocodile tears they shed for the difficulties faced by would-be young home buyers, they know that in any given year there are only 100,000 people who succeed in becoming first home buyers on average, and maybe for every one that does, there's 4 or 5 who fail. So there's perhaps 500,000 votes for policies that would slow the rate of house price inflation. But at the same time, politicians know, even if they never say so publicly, that there are 11 million voters who own at least one property. Within that total, there are at least 2 million who own 2 or more properties. And the last thing those 11 million voters want is governments to do anything that slows the rate of property price inflation down. I mean, John Howard, who was a pretty astute reader of the mood of the electorate, which is why he won 4 elections on the trot, he sometimes used to say that no one ever came up to him on his morning walks and said, please, Prime Minister, would you do something that makes my house cheaper so that someone else can afford to buy it from me more easily? And, he was right in terms of what people think. So governments and oppositions keep coming up with policies that, whatever they say is the intention towards first home buyers, have the result of making those who already own at least one property richer. And the evidence is that that wins votes.
Well, how does Labor's plan compare then to this?
Well, Labor's shared equity scheme will, I think, put a bit of upward pressure on prices as well, because it allows people who take up the scheme to spend more on housing than they otherwise would. But there are 3 features of Labor's scheme that at least make an attempt to limit that impact. One, only 10,000 people a year will be allowed to access it, which is about 1/10 of the number of first home buyers each year, and a much smaller fraction of the total number of housing transactions that occur each year. Number 2, there is a limit on the income of people who can apply for it. And number 3, there is a ceiling on the value of properties that can be purchased with it. And there's a bias within that to people who buy new housing, which at least adds to the supply of housing, as opposed to people who buy established housing, which just churns it rather than adding to the supply of housing. So at least Labor has made some effort to limit the impact that their scheme will have in pushing house prices up, whereas the Coalition has made no attempt at all to constrain the impact on prices. And it's interesting that Senator Jane Hume, who is the minister responsible for superannuation, was on the radio this morning, apart from falsely suggesting, as she did, that my view was based on the fact that I probably own more than one house. I actually don't, and she didn't bother to check with me about that. But even she conceded that it would cause a bump in house prices. And, that's what you don't need an economics degree to understand that if you give people or allow people to access more cash in order to pay more for housing, the result's going to be higher house prices.
Now, Saul, I want to ask you about, what about the plan? I mean, it will force pensioners to lose their pension after 2 years due to the assets test. I mean, this must concern you.
Well, I guess the assumption is that if people have put the proceeds of selling their house and downsizing, that is the difference between what they get for the house they sell and what they pay for the presumably smaller house or apartment that they then move into, they put that money into their superannuation fund, paying very little tax on it, and as a result they are getting a higher income stream out of their pension fund and hence are less likely to need the pension. I mean, that ultimately was the whole point of superannuation in the first place, is to reduce the number of people who are dependent on the age pension. They get 2 years of, in effect, free money. That is to say, they get 2 years where whatever income their additional super savings generate doesn't result in a reduction in their pension. I'm not particularly concerned about the implications for those people of that 2 year period. They're doing pretty well.
Can I ask then, I've got Housing Minister Michael Sukkar joining us later this morning. If we could put a question to him on your behalf, what would it be?
It would be, why does he, and he's not the only one, I mean, I'm not singling him out for this, why do governments continue to pursue policies that inflate the demand for housing? And as his colleague Jane Hume conceded on ABC Radio this morning, will cause a bump in house prices? Why do governments keep doing things that we now have 60 years of evidence to show don't work?
Good question. I shall put that to him on your behalf, Saul.
You're welcome. Thank you for doing that.
And I'll
be interested to hear his answer, and I'm sure he will duck and weave.
Oh, look,
he won't answer the question any more than Jane Hume did when it was put to her.
I'll tell you what, obviously Jane Hume's made you quite cranky, but I tell you what, it's a pleasure to have you back, and I'm really grateful to have a chat to you, Saul, as always, and I look forward to another chat in the near future.
Sure. Thank you, mate.
Thank you, Saul. Good to talk to you, mate. Saul Eslake, our resident economist with Tasmania Talks.